I think a lot of people get confused when it comes to these rollover rules, but they're pretty stringent. And if you make a mistake, it can cost you dearly.
I mean, one option is also to take it in cash, but we never like to see that.
Don't say that.
It definitely sets you back quite a bit from retirement, but that is one option with 401k plans.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Today's special guest, Michelle Cannan. She is somewhat of an expert in the 401k industry. And because that is typically a person's largest asset, we thought it would be great to bring her on for some education and talk about what the plan sponsor's role is, what the plan provider's role is, and what your role as the plan participant is in your 401k. Please enjoy my conversation with Michelle Cannan. She is Managing Director at Modern Wealth Management. All right, we have Michelle Cannan, Managing Director of Modern Wealth, as well as Head of Company Retirement Plan Services, joining us here on the Guided Retirement Show. Michelle, welcome.
Thanks, Dan. It's good to be here.
It's good to have you here. This is a subject that we really want to talk about, and we're going to talk about 401k key things to know about. And I think when people start thinking about their 401k, they don't really understand the difference between the plan sponsor, the plan provider. Is there a financial planner role there? And all the things that they need to be aware of within their 401k plan. And you have a whole host of people who are participating in a 401k, all the way from the individual who's just starting their career to a person who may be changing careers and changing companies and what they do with that 401k when they leave and go to a new company. And then you have those people that are nearing retirement. So, Michelle, I'm excited to talk to you about this. I hope that our viewers and listeners can get some good education here. So let's start off with your role as Head of Company Retirement Plan Services, and tell us more about what your role is in the 401k world.
At Modern Wealth, we have a whole team of retirement plan advisors who help plan sponsors with really four main things. The first one is investment selection and monitoring. So deciding which investments are going to be available to employees for them to select in a retirement plan. The next thing is plan administration. So every retirement plan, every 401k, 403b, they're all designed differently to suit the needs of the company and the employees. There's no two 401ks that operate exactly the same way. So we help ensure that the plan is administered correctly per the documents. But there's also a lot of required documents and government filings associated with maintaining a 401k plan, and we provide assistance with those. We also provide assistance with different service providers. So with a retirement plan, there's different vendors that work to provide services, and we support the selection and monitoring of those service providers, and we conduct fee benchmarking, which is really important to make sure that we're ensuring everybody is paying reasonable plan expenses. And then last, but definitely not least, we provide employee education. And that's really important to individuals that are participants in retirement plans. But also for business owners, they have a duty to provide employees with enough information to be informed investors. So we offer an education program that includes group and individual meetings with a focus on helping employees understand the retirement plan benefit, but also the importance of saving. That's the retirement plan advisor. There's also a plan record keeper, and the record keeper is the company who tracks who is in the plan, what investments they own, what funds are deposited and withdrawn. They also maintain the website where people go to log in to view their accounts. Wherever you go to log in to view your 401k plan, that's your record keeper. And then we are the plan advisor that helps with all of the things that I just mentioned.
Okay, so let's talk a little bit about the plan sponsor's role. And the reason I'm doing all this is because I want to talk about some misconceptions that employees that work for companies have when it comes to their 401k plan. So let's talk about the plan sponsor's role.
So the plan sponsor is the employer or the company that offers a retirement plan benefit for their employees. So it can be a 401k, so most commonly a 401k, but it can also be a 403b, so that would be for nonprofit companies, or a pension plan, or other types of retirement plans. And the plan sponsor is considered something called a fiduciary. And what that means is that any decisions regarding the retirement plan benefit have to be made in the best interest of plan participants, so best interest of employees. But offering a retirement plan benefit comes with a lot of responsibilities. So they have to make sure the fees are reasonable, that the plan is in compliance with all of the laws and regulations, monitor the vendors that work with the plan, and really important, ensure the employees are receiving enough information to be informed investors. So to provide education for employees or participants of their plan.
Okay, so this is where I think confusion comes in, Michelle. The plan sponsor, the company, comes to somebody like yourself and says, hey, I want to provide a 401k plan for my employees. And so they contact you to go through all the things that you just said. So from the employee's perspective, I've heard this many, many times, working as a financial advisor with people that work for other companies. And they say, well, my company, they did all the work. They picked all the investments. They were a fiduciary. And so I don't have to worry about anything on this plan because the company's done all the work. But the reality is, one of the parts that you talked about is the education, and the onus of the success of that 401k plan does not lie on the shoulders of either the plan sponsor, the company, or the plan provider. The onus of success of that 401k lies squarely on the shoulders of the employee themselves. And so I think that a lot of people think, wow, my company's taking care of me. They've got this plan set up. But the reality is, it's your money that's going in. The company may provide a match that goes in there, but it's your responsibility to become educated to a point where you can actually understand what those investment choices are and make an informed and intelligent decision as to where and how that money should be invested.
Yeah, and that misconception has actually become, I think, more common over time because a lot of 401k plans now have something called automatic enrollment. So if an employee is a new hire at a company and they don't make any election at all, automatic enrollment will happen and they will automatically be enrolled in the plan at a rate designated by the plan sponsor. But that might not be enough for them to meet their retirement goals. I've seen it where plan sponsors say, yes, we'll automatically enroll people at 1% of pay or 3% of pay. And oftentimes that's not enough for the individual to have a successful retirement. But because it's been marketed and introduced to them as you're automatically enrolled, we've got an automatic default investment for you, the employee feels like it's already being handled for them.
Yeah. And the other thing I think that happens there is they automatically choose the investment for the employee as well. And oftentimes it's one of these age-based or year-based. So maybe it's a 2050 fund or a 2055 fund. And there's really no thought or process of that individual that says, okay, this is what you should be invested in. They try to make it where it's easy, but without the right education, which I think is really critical for what you're doing for the companies, you're providing that education to help people make better decisions. So when somebody gets automatically enrolled, Michelle, are they automatically enrolled in the traditional side of the 401k, or are they automatically enrolled in the Roth side of the 401k?
Usually they're automatically enrolled in the traditional pre-tax contribution.
All right. So that could be something that is not what a person wants. And so
right.
let's take the time here to talk about where a financial planner's role might come into that 401k. And again, whether you're just starting out, whether you're mid-career, whether you're in the final years of your career, getting a financial planner involved at some level to help you as the plan participant, the employee, understand your choices and make the right decisions for you is going to be critical. So let's talk about that financial planner's role to help them decide, should you do pre-tax? Should you do after-tax in the Roth? Should you do a combination of the two? Where's the company match going to go? How much should I put in? Those are all questions that every employee should be asking themselves when it comes to their 401k plan. It's not just about what's the underlying investment.
Yeah. And our retirement plan advisors have a really comprehensive education program, but it's not as personalized or as thorough as what people receive when working with a financial planner. Our education program helps people with the accumulation phase, right? So helping decide how much to put in, Roth versus pre-tax, but every person has a little bit of a different scenario. And it does help if there's a financial planner involved, or maybe your CPA as well, right? To help you determine for the pre-tax versus Roth decision. We can help them understand the plan, help save for retirement, but especially leading up to the change from saving for retirement to spending in retirement, financial planning is absolutely key leading up to that point and in retirement. But I agree at every step of the way, if you have a team of people that you're working with, financial planner, a CPA, to help make sure that you're making those personalized decisions in the right manner, that's really helpful.
Yeah, Michelle, I agree. And that's why at Modern Wealth, we've taken a lot of steps to make sure that we've got the financial planner in place. You're there acting as the plan provider. And then we've got the CPAs in place too. And this idea of whether I should do Roth 401k or whether I should do traditional 401k isn't just a decision that should be made or thought about when you're enrolling in the plan. It's something that should be made and thought about on an annual basis based on your income, based on your spouse's income, based on how much money you're going to need to have deposited to your checking account month after month for as long as you live after you retire, and taking into consideration that a Roth portion of that 401k is going to come out tax-free. Well, the traditional portion is going to come out as ordinary income. Well, what's my income going to be in retirement? And what's my income today? Maybe I'm in my later years and I'm on my peak earning years, and I want to take advantage of the tax deduction by going to a pre-tax traditional 401k in those final years, getting a bigger deduction, and then planning on doing some conversions of traditional over to Roth in the first few years of my retirement, therefore getting that money into a Roth IRA in a much more tax favorable thing. And that's where the financial planner actually comes in and creates that forward-looking plan to say, what is it you're trying to do here? What do you want the rest of your life to look like? What are taxes going to look like in the future? And then they can actually give an informed and intelligent decision to that individual.
Yeah, we can talk with people about those options. We can make sure that those options are available in the plan, right? Making sure that people have the ability to do a Roth contribution in a 401k is really important. One of the things that a lot of people don't realize is that Roth 401k contributions don't have that income limit that Roth IRAs do. So, Roth IRA has a phase out. If you earn over a certain dollar limit, you can't contribute to a Roth IRA. But in the 401k plan, a Roth 401k contribution can happen for anyone, regardless of income. And the Roth 401k limits are up to the regular IRS 401k limits. So this year in 2024, it's $23,000 or $30,500 if you're age 50 or older. So that's one item for everybody to know, that the limits are higher, and that income limit that applies to Roth IRAs does not apply to Roth 401k. So
that gives an individual a big opportunity to kind of, I would call, supercharge that Roth portion of their 401k. And for those people that are either watching us on YouTube or listening to us on their favorite podcast app, I want people to understand that there's no better tax rate than zero. And that's what you get with the Roth portion of your 401k or the Roth IRA. And so, getting as much money into that Roth portion, I think, is critical. But again, you may be in your later working years and you may want to say, let's let's take that 30,500. Let's get a deduction on that today because I'm in a high tax bracket. I've saved some money outside of my 401k that I can live on for a few years after. Then maybe I can take that money from the traditional side, move it over to the Roth side, maybe at a 12 or a 15% tax rate, as opposed to, putting it in on an after-tax basis while I'm working, and maybe I'm in a 37% tax rate.
Yeah, absolutely. And some plans, depending on what's available, allow in-plan Roth conversions. So you can actually take any pre-tax source that's in your 401k and convert that to Roth.
And again, that's a question that is not easily answered. You may have some people say, never do that. You may have some people say, oh, it's the best thing ever. But really, it's an individual, very personalized answer to that question. And it's not going to be the same for everybody. And maybe a portion needs to be converted, or maybe maybe it's, oh, no, don't convert now. Let's wait until you retire because you'll be on a lower tax rate at that point in time. So that's where the CPA working alongside the financial planner really come in to help you make that right decision.
Absolutely. The other thing to know about Roth 401k is that if you move, if you retire and you transfer your Roth 401k to a Roth IRA, that 5-year time clock with the Roth IRA starts over unless you're transferring it to an existing Roth IRA, even if that Roth money has been in the 401k plan for more than 5 years. So it's something that, if you're using your 401k as a strategy to accumulate the Roth source, you want to make sure that you're working with a planner in advance to make sure you have enough money available and start that 5-year time clock before you retire, if possible, outside of the plan, so that you've got that Roth IRA already existing.
You make a good point there, Michelle, and I want to elaborate on that rule, the 5-year rule, just a little bit. And so many people are under the understanding that I'm penalized or on a 10% penalty if I pull money out of that Roth IRA before 5 years or until I've attained age 59 and a half. And by the way, both of those things have to have happened in order for you to get total tax-free withdrawal. But that penalty only applies to the earnings of the Roth IRA. So let's say, for an example, that you had $100,000 that was in the Roth portion of your 401k. You're 60 years old. You roll that out to a Roth IRA. You can spend that entire $100,000 because it's taxed as a last in, first out basis, and that's just a complicated tax rule that comes into play. So we can pull out a total of $100,000 within that 5-year period, and it's only when you exceed that $100,000 that penalty actually applies. So understanding those rules is also critical. So I don't want someone to think that I have to have a Roth in place in order to roll that over into a Roth, or I can't access any of that money without a penalty, because you can always access the amount that went into that plan. So just some nuances in the tax code that people really need to understand. Let's talk a little bit about once a person leaves a company, and let's say they want to go to a new company. They're not at the end of their career, but they're changing jobs for whatever reason. They have options. They can leave the money with an existing plan sponsor, and all the fiduciary rules are still intact. They still have to do the same things. All the investments remain the same. Or they can take that money and they can roll it directly to the new company's plan, or they can take that money and they can roll it to their own IRA and be in full control over the underlying investments. And I think a lot of people get confused when it comes to these rollover rules, but they're pretty stringent. And if you make a mistake, it can cost you dearly.
I mean, one option is also to take it in cash, but we never like to see that.
Don't say that.
It definitely sets you back quite a bit from retirement, but that is one option with 401k plans. So when we're talking about distributions, we have to mention all possible types of distributions.
Sure. So let's just do that whole cash option just for an example, because way back in the day when I started in this business, people did that a lot. And because they said, well, I've got 60 days to get that into an IRA. So if you're working for a company, and I'm just going to keep using this $100,000 figure, I got $100,000, I'm going to move to another company. Well, I can take that cash. There's going to be an automatic 20% withholding Now, that's not the taxes that are owed. That's just an automatic withholding. It could be more,
And
it
that's
could be
just
less.
federal taxes too. If you live in
Exactly.
a high tax state like I do in New York State, that's another maybe 7% on
Right.
top of the point.
So if you wanted to roll that $100,000 over, you have to come up with the full $100,000 to roll to an IRA, and you got 60 days to do it. Now, if you do that, whatever taxes were withheld, federal and state, you'll get those back when you file your tax return. And to avoid that complication, you do what's called a direct rollover, where you're requesting that the plan provider make the check out to the IRA of yourself or to the new company plan, not to you directly. And that avoids that automatic withholding, and it avoids the 60-day rule.
Correct. Yep. The check is payable to the new IRA company or the new 401k plan for the benefit of you.
All right, let's move on to talk a little bit about in-service withdrawals. Now, not all plans have an in-service withdrawal, but some plans do have an in-service withdrawal, which allows an individual, while they're still employed, to do a withdrawal from that 401k, rolling it directly to an IRA to open up additional investment choices. Do you see that as something as commonplace in most plans, Michelle, or is that something that is just really dependent upon the plan sponsor themselves?
It should be more commonplace than it is. We have seen more plans adopt this over time, but what we like to see is a retirement plan that allows you to request a in-service withdrawal or a rollover to an IRA at age 59 and a half. That allows you full flexibility to take any of your account balance and move it to an IRA to work with a financial planner, maybe before you start to retire, and work with them to prepare for that. But 59 and a half is where we like to see that age.
All right, I agree with you. I think that's a great rule, and I wish every plan had it, but they don't.
Right.
The people that do have it, I see it utilized quite a bit because you just have so much more flexibility and so much more control, especially in those few years you have left leading up to retirement.
And you can still continue to contribute to the plan
right
after you take an in-service withdrawal or in-service rollover. You can still continue to contribute. You can still receive any company contributions that might be in your plan. It just allows you to work with your financial planner before that retirement date.
Let's talk a little bit about beneficiary rules and ERISA. Probably one of the least understood things is beneficiaries on your 401k plan. And I've seen some things happen that should never happen, but ERISA has some very specific rules when it comes to who is the beneficiary of your 401k.
It does. And first, I just want to explain, because there's a lot of acronyms with retirement plans. ERISA is the Employee Retirement Income Security Act. It was a law that passed in 1974, and the beneficiary rules relate to ERISA plans, which 401k, 403b are ERISA plans. So it's really important that you have a beneficiary election for your retirement plan account. It's very easy to make the election. Most record keepers now, you can log into your 401k account and make the beneficiary election right online. Some employers still require a paper form instead. But by law, your spouse is your default beneficiary. So if there is no beneficiary named on the account, your spouse is the default. Some record keepers, though, I have seen the spouse is half of the default and half goes to your estate, which can be a real headache.
Tax nightmare is what I'd call that.
Yeah, a tax nightmare for sure.
Yeah.
But you can also name secondary or contingent beneficiaries. So you can name your spouse as primary, but other, secondary beneficiaries if something were to happen to both you and your spouse. Where we see problems coming from this are the following. Let's say, and we've seen these in real life, let's say someone elects beneficiaries, non-spouse beneficiaries, and then they get married to somebody else. The spouse is automatically your beneficiary, even though you elected somebody else, unless the spouse signs a spousal waiver form indicating they understand they will not receive the benefit, and that form usually requires a notarized signature. So that's a problem when, you're remarried, the spouse automatically receives it, but the original beneficiaries on the account and the owner of the account may believe that the money is going to somebody else.
Yeah, that's created a lot of time in court for a lot of people that have tried to fight that. And the fact is that the ARIS rules are going to triumph what any person thinks is logical. They say, well, logically, I didn't name my spouse because I already had my kids named as the beneficiary. That's obviously what dad wanted or what mom wanted. Well, that doesn't seem to matter to ARIS because they say, well, the new spouse didn't sign off on that, so tough luck, kids.
Correct. and it's not just a spouse's signature. It's usually, it has to be notarized. There's a formal procedure. So yeah, that can cause a lot of headache and legal drama, like you said.
So one other thing real quick here that I want to talk about, and this would be specifically for publicly traded companies where the company stock is an investment option in the 401k. There's a little known part of the tax code that relates to something called NUA, or net unrealized appreciation, and it applies only to publicly traded stock where that stock is available for purchase inside the 401k plan. It's a huge tax savings and tax planning opportunity if it's understood. And so I think let's just take a couple of minutes to explain the NUA, Michelle.
Sure. So when you have company stock in your 401k plan, if you take a lump sum distribution of all of that, all the stock in that account, you can pay lower capital gains rates on a portion of that instead of paying the typically higher ordinary income tax rate. So normally, if you received a distribution from the 401k, you're going to pay ordinary income tax rates on that. This allows you to pay usually lower capital gain tax rates on that company stock portion. So NUA is the difference between the price you initially paid for the stock and its current market value.
Yeah, so the real ones that could be like just some names that people would recognize if you worked for NVIDIA, Microsoft, Apple, Meta, Google, those types of companies where maybe you didn't contribute a ton of money and your contribution is considered your cost of the stock, that's your basis. Any appreciation in that stock is considered to be gains. And so that's why I call it net unrealized appreciation. And so when you take that lump sum distribution, you'll actually pay ordinary tax on the basis or the cost. Therefore, and then anything above that will be treated as a long-term capital gain. And so, we saw a scenario here. This has just been earlier here in 2024, where an individual had an $83,000 cost basis. The stock was valued at over $1 million. So we were able to say, look, let's take that stock in NUA kind and take the stock in kind. You pay taxes on the $83,000 now, but the balance of that is then subject not to ordinary taxes, but to long-term capital gains rates, which are far more favorable than the ordinary tax rate. So that's just, again, taking money out. That's, again, part of the rollover rules that people need to be aware of. And I would say this, when it comes to getting money out of a company-sponsored plan, don't try to do this on your own. Get some professional help because there's a lot of nuances to this. And if you make a mistake, the IRS doesn't give you a do-over.
Yeah, if you have company stock in your 401k, you should absolutely be working with a financial planner to make sure that you can take advantage of these rules. But really it applies to everyone, making sure that they're making the right decision because there's no do-overs, right? You can't say, oh, I made a mistake, I'll go back to last year and do it again. Once you make that decision, there could be ramifications.
I think about it like my golf game. If I hit a bad shot, I get a mulligan, right? I just do it over. Well, there's no mulligans when it comes to distributions from 401ks. Even IRA to IRA transfers, there's a lot of rules that come along with that. Michelle, you work in a very complex and highly regulated industry, and you also work in an industry that controls the vast majority of individuals' wealth. Your job is critical. What the companies do as the plan sponsor is critical. But I want everybody to remember this. The onus of the success of the plan, all of the tax rules and the complicated things of rolling over, using the NUA, whether you do a Roth, whether you do traditional, that's on you as the plan participant or the employee. And that's why I think it's so critical that you work with a financial planner, and hopefully that financial planner also has a team of CPAs there that understand the complexities of all these rules, because you work hard to get the money into the plan to get yourself to a point where you can experience that financial independence where your money's now working for you. The last thing you want to do is make one little mistake that can cost you way more in taxes than what you should ever pay.
Absolutely.
Well, Michelle, I think that we've covered a lot of the nuances of the 401k. I know that there's a lot more. There's a lot more education. I want to thank you so much for taking the time to join me here on the Guided Retirement Show, and I look forward to having you back as a guest in the near future.
That sounds great. Thanks for having me on the show, Dean.
You're welcome. Have a good day.
You too.
Thanks again for joining us here on the Guided Retirement Show. I'm your host, Dean Barber. Make sure that you are seeking out the help of a professional when it comes to all the complicated things that Michelle Cannan and I discussed today. Make sure if you're watching us on YouTube, you're clicking the bell icon and giving us a thumbs up and sharing with your friends. And do the same thing if you're listening on your favorite podcast app.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.